Hey everybody, Michelle Noel here. Welcome to my channel. I am going to roll this segment out as raw and real. So a little play on words, but I just want to be as authentic as I can. No editing, just try to just roll with it. So if you hear a dog barking, that would be McCoy. And so anyway, that's kind of how we're going to roll with this. Life's too busy. I want to be able to get this content out. I think it's valuable. It's going to be really informative. I do want to give you a little bit of my background, but if you find any value out of any of what I'm sharing with you today, hit that subscribe, hit that like button, and that way you get more alerts as more content's going to be flowing out your direction. So very, 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 very excited. My background's mortgage. I've been a lender for 30 years. I've been a realtor for 18. Very passionate. When I was a real estate agent, I absolutely loved taking all that mortgage experience I had and tying that and using that to help folks who thought they could not buy a home and help them make their dreams come true into home ownership. So I really, really, really was passionate about that. And then in 2019, I made a career change. And that was very much led into a guided direction that I felt a calling to. And that was going in the life insurance arena from my real estate career. So I have a now tagline that says, I was a real estate agent that made it happen and got it done to get my clients into their home. And now I want to be that agent to help families keep their home, keep their dignity, keep their assets, and not have things just wiped out in a moment's notice. And I'm not just referring to, when I say a life happens event happening, I'm not referring to death. I'm actually talking about medical, cancer, terminal illness, heart attack, stroke. I mean, you just name it. Lou Gehrig's disease, dementia, permanently paralyzed from the waist down. I mean, epilepsy, things that get diagnosed that you did not plan to get, and now you're managing to it. And then that lifestyle change financially, asset wise, and how that's impacting as far as having to cover the treatments and things of that nature that maybe your health insurance isn't covering. I mean, all of that, Mirage. Okay. So I'm here for a reason. Okay. So I'm just putting that out there. I'm very passionate about this. So yesterday I was putting together a series of illustrations. I probably went through 12, 14 of them or so. And I'm focusing on a 43-year-old client of mine. And I thought, you know what? When I put this worksheet together, I was like, I really need to get this content out there. So that's what I'm going to do. I'm going to unveil this. I'm not going to share his name, but he's going to be defined as a 43-year-old male non-smoker. And I want to be able to walk through this as those who are 40 years old. If you know one, if you are one, if you're in your 30s, you should also watch this. But I think there's just a lot of valuable information. So I'm going to walk through that exercise and basically just take you down a journey. And I want you to come from an element of being an advocate for your future self, if that makes any sense. I hope it does, because I'm really big on that. And check out some of my other YouTube videos as well. There's one that might seem a little cray-cray. I am going to do it in segments and not, I have a tendency to have, I call it my hamster jumping around in the hamster wheel. And that one definitely happened. But you'll get the gist of some paradigm shifts that I had happen in my business. And I'm very excited. And I do feel like it was definitely guided by spirit, God. And I am very much a Christian. I definitely believe in God. And I am just excited that I had such a dynamic shift in how I'm looking at being of service to my clients and to families. Okay. So with that being said, let's dive in. Okay. So what I'm going to do is I'm going to share my screen, and let's get in here and do that. Okay. All right. So, yep, I put the tagline in. Every 40-year-old plus should watch this. Okay. And again, the clock is ticking. So you know, we all think we've got tomorrow or nothing's going to happen to me. And I'm just here to say, go to the hospital, go to the emergency, go to the cancer treatments. Everyone felt like that was going to be the case and nothing like that was going to happen to them. So you just need to be an advocate for your future self. So I'm not going to harp on that too much. Maybe I will. I don't know. We'll see. All right. So what I want to talk about, I'm going to go into cover sheet on this, on what we're going to talk about. Oh, I'm going to pause this for one brief second because, hold on. Oops. Recording, pause. Oh, now I gotta get back over here. Okay, so what we're going to do is I'm going to go over what I'm going to talk about. And so let's jump to that screen. All right, so again, this is a case study for one of my clients who is a 43-year-old non-smoker male. And there's three things in that is actually very key in determining cost in an insurance product. It doesn't matter what the insurance product is, but it's your age, it is your gender. I should have put in there he's healthy because he is. There's no health issues going on in his world. And being a smoker or a non-smoker. Those are four major components that dictate cost of insurance. So age being really prevalent and health being really prevalent, non-smoker, smoker being prevalent. I have coverage for everybody and anybody, including anybody that's dealing with some severe, you know, health issues that things look very dismal, but you want to make sure you got something to get you through that period of time, whatever's going on, and then we can go into more detail. So you always have my contact information down in the description of this video. So I just want to communicate that. But I wanted to point that out because those are very key specific things that are very important. So the older you get, the more expensive it gets. Okay. All right. So we're going to talk about indexed universal life. We are going to briefly talk about term, that's down there at the bottom. But going into the indexed universal life, I'm not going to dig too much into credit indexing strategies or anything like that. But I will tell you that if you have this product, an indexed universal life product, I would highly, highly, highly encourage you to go pull it out and go look at that illustration, because I'm going to share some things with you that I think are very important and things that you should pay attention to. And if you are shopping for an indexed universal life, I think you should also look at these factors as well. And not all indexed universal life products are created the same. There, you know, definitely have different indexing strategies in place and things like that. But I focus on is how long is the policy guaranteed for? Okay. So we're going to talk about that. We're also going to talk about the concept of return of premiums. Sometimes they'll see the acronym ROP. That's called return of premiums. What that means is everything that you paid into it, can you get some of that back? Can you get a portion of that back? Can you get 100% of that back? Can you? And what are the guidelines realmed around that? Okay. We're also going to talk about the fact that I did this illustration worksheet comparison worksheet, and side by side. So we're going to talk about one policy, but yet designed in four different ways. And I want you to understand how versatile an indexed universal life is and how it could be structured. And you get to dictate that. It's your policy. You can create your own cruise ship, basically. You can create your own wealth. You can create however way you want to do this, okay? And I'm not guaranteeing wealth, but I'm just saying that they are designed to be able to create opportunity and leverage that. My job is I want to make sure the next topic, fund for a guarantee till age 90. So if you go pull that policy, if you have one, or if you had somebody share one with you, what if you were to go to where the numbers line out where they say, oh, look at the last three columns, so you have no idea what I'm talking about, it's okay. But those that do, you know, I'm saying I want you to look at the first 3 columns, because I would say about 80, 90%, if not more, trying to be very kind here, that the average policy for a guarantee for an indexed universal life, and I'm not talking about a GUL, I'm talking about a guaranteed indexed universal life where it was designed to be guaranteed. Okay. So I would say the average is 20 years. So if you're 43, you have one of the average situations, that more than likely it's only guaranteed for 20 years. So I just want to communicate that. Okay. And the other piece of that is then I'm talking about giving you an opportunity for a max funding to compound growth, like what that situation is going to look like if you were to max fund it to give yourself some amazing compound growth. And then I'm going to give you an instance of a level. So I'm going to give you a level comparison, and a level is like, basically just see it as like the horizon. It just stays steady across. And that's more focused on building cash value more exponentially. And then if you're doing increasing, that's basically to have that policy value, not the cash value, increase and go up. And I look at that because I think it's important. If you're in your 40s or 30s or 20s, whatever, there's a lot of value, even in the 50s, in this era. Okay. There's a lot of value to have an increasing death benefit, and shouldn't even be calling it a death benefit, but a benefit in the policy value, in the fact that as we're getting older, we want to have more available to us. Okay. And that's why the difference is between level and increasing. Okay. So again, level is you're building cash value, a lot more concentrated focus. And as the cash value is building up, then maybe the value of the policy coverage is going to increase as well. So similar to like a whole life type situation. Now, the increasing, this is where the focus on isn't so much on cash value accumulation, but on trying to get that policy to grow faster, the death benefit to grow faster, and then you could turn it off. Okay, once you get to a point where you're comfortable with. So in the illustrations that we're going to talk about, I turned those increasing ones off at age 60. Okay. Now, and there was a key point for that, but we'll get into that here shortly if I remember. So anyway, and then we're going to talk about living benefits, you all. So living benefits, okay? So you do not have to die to have access to this policy. You can be the beneficiary to your own policy while you're still living. Living benefits is super key, super, super, super key, okay? So chronic illness, critical illness, terminal illness. So heart attack, stroke, Lou Gehrig's disease, any of those situations. You guys, I've had family situations that have transpired that I've witnessed. I've had my own real estate clients impacted with a life happens event happen. And I have just seen pure just levels of stress and panic and turmoil. And mostly about the finances, like, and it really should be where we're focused on healing. And it's just sad, but we are living longer, but we are living sicker. So I just want you to really, truly, truly take to heart when I say be an advocate of your future self, because we're not getting out of here alive, number one. So it definitely is going to be the inevitable that we're going to have a passing. And I would say, while you're your youngest and healthiest today, take advantage of what that looks like. All right. And so just communicating that. And then we're going to talk about a term. And then you're going to say, why wouldn't you? Why wouldn't you? You're going to see it. And you're going to be like, why wouldn't I? Why wouldn't I do this? Like, why not? So we're going to talk about that. And then I'm going to go into showing you side by side the power, the negative impact of procrastination financially. It's crazy. So the numbers don't lie. They just don't. They don't lie. They don't lie. So I really, 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 really hope you get a lot of value out of this. It's so my intention. I just, like I said, I was putting this together for my client yesterday, and then I was like, oh my gosh, I have to get this out. I want to be able to share this and educate. So I plan on doing more case studies and putting something together similar to what I'm doing today. And they will not all be equal, but you will certainly have an opportunity to be educated and come along for a journey of that education. So anyway, hopefully you enjoy. All right, well, let's get into it. So here we go. Okay, so again, like I said, this is a case study for my client who's 43 years old. Okay. And so whenever I do any work with a client, I'm always going to do these side-by-side worksheets because I'm truly delving in pretty deep. I did easily about 12 to 13 illustrations because I really wanted to hone in what I felt like would probably be the most valuable. And in this situation for this gentleman, I didn't want to focus on putting a high dollar amount out there. I wanted to keep things very baseline. And I think it's a good way to start. I wanted to keep it at 100,000 and as far as coverage. So that's what I focused on. Okay. Was just keeping things simple and moved it over, for each illustration, just kept it at 100,000. And that way I can go through some of the concepts and you can truly see an apples to apples comparison. All right. So that's what you're going to see. Now, this top line, whenever you see this, when I do my work, basically I'm defining what is the product and what, carrier and what are some of the features out of it. So all of these are going to be a guarantee to age 90. Again, I did apples to apples comparison. And then all of them are going to have a return of premium opportunity. So again, those that have a IUL, an Index Universal Life product, highly, highly, highly recommend that you go pull that out. And I want you to take a look and see, based on what I'm educating you about and why I feel like it's okay to have some opportunity in there, but it's also important to have some guarantees and some added layer of protection on top of just having the life insurance policy in general, if that makes any sense. Hopefully it does, because that's my focus here. All right. All right. So this all says guaranteed and a return of premium. And then I went into the age 48 because I wanted to show what a policy is going to look like 5 years from now if you wait. The numbers don't lie. It's crazy. All right. And then I'm doing a term is what I'm going to show you what that looks like as well. Okay. So let's start with this first column here. We're going to dig deep into this. How about that? Okay. So the face amount, like I said, all the way across the board would be 100,000, except for one of them. And we'll get to that in a minute. But I want to explain the rating factor. Okay. So there's standard rating. I always want to just not create clouds in the sky or, something like, oh, I can get you this or whatever. I want to give, here's the number. And if I can get you qualified for a preferred rating, then I'm going to shoot for that as well. But that's going to be more like an over delivery, only because I don't want to promise something that I can't deliver. And there is also a big thing in this that these are underwritten, or they can be fully underwritten. What do I mean by fully underwritten? Meaning that they are going to pull your medical bureau records. They're going to pull those details. You're probably more than likely going to have what they call a paramed. And a paramed is an examination where someone's coming to you. They're going to draw your blood. They're going to pee in a cup, in privacy, of course. But they need to get an exam records of what your current status is now. Take your vitals, weigh you, blood pressure, all of that stuff. So again, wouldn't it make more sense for you to do that when you're in your 40s, 30s, 20s, and not in your 50s, 60s, 70s? Okay. Because again, the mortality rates are based on risk. I mean, the way these insurance policies are put together is all based on risk. And the older you are and sicker you are and issues that are going on, it's going to be a lot more expensive And you could actually put yourself in a corner where you potentially are looking at only a guaranteed product, and it's expensive. It could be expensive, again, depending on how old you are. So I just want to communicate that. So now there's this other type of product. It's called a simplified issue. And a lot of people, I don't know. So let me just explain it. So simplified issue, how that works is you're bypassing having a fully underwritten policy, bypassing it. So you're bypassing the paramed. You're looking for an instant approval. Okay. And I'm not saying it isn't warranted at some point, but if you are healthy, why would you pay an extra $100 or an extra $50 a month or $100 or whatever, $200, $300 a year for the convenience factor that's only going to take you out of your time for maybe an hour? And yet you're going to pay this higher premium for the rest of the time that you're going to have this policy, or the time that you're going to pay it till. And in this case, I put to age 65. So you can see that right here. Okay. So I don't know. I understand we want convenience, and, we want to go through the drive-through. We want to just get our instant this, that, or whatever. And I just feel like it makes sense to take your time, because these simplified issues actually can cost more. And I didn't do any comparison of that, but I'll do that in another video. But it's just really important that you understand the difference. So these are all going to be fully underwritten in these illustrations, and they're defined as that. So these are quoted as a standard rating, and I will push to get a preferred rating. And so it would be even less than this, but I don't want to set the wrong expectation. So I want the digestion of, here's a standard premium. Can you work with that? Okay. All right. So then the return of premium. So in this situation, this is actually an opportunity to get 100% of all the money that was put into this policy anywhere from year 20 to 25. Okay. Now, year 26, you don't have that opportunity anymore. So 20, 25 years, that's a pretty good amount of time to see if that policy is performing to the degree that you had hoped it was. Remember, we talked about the guaranteed columns. There's the left 3 columns are your guarantee. I don't know if I mentioned that. I did in the previous video that it was not recording. So it's been a whole hour. This is take 2. But anyway, so so the right 3 columns actually are what a lot of times the focus is on. And yes, it can be a conservative illustration in the indexing that's being the rate that's being illustrated. But we don't know what tomorrow is going to bring. We just don't know. And if you do have a policy in Index Universal Life, again, I encourage you, I implore that you pull that policy out, take a look at your original illustration, and look at where you are today. And whether you've had it 3 years, 5 years, 10 years, I really think it's important that you take a look at it and see what you're seeing, and then reach out to a life insurance agent if there's something that you want to get in that gives you a little bit more of that added layer of protection. And you may not need to do that, but I'm just saying, I want the guarantees to age 90. I want this policy without a doubt to be in place to age 90. Okay. Some instances, if it's an older individual, I can get the policy coverage to age 100. But the majority of the times when basically everything I'm coming up with what I'm looking with and I have a lot of carriers, we're looking at age 90. But the average IUL is only 20 years for a guarantee. Okay. So again, if you're 43, that only puts you at age 63. So I would prefer to have you protected at age 90. And certainly by age 90, you're definitely going to have funded this policy the way you need to ensure it's going to be there as you need it. Right. So, and we'll get into that. So, death benefit, 100,000, has living benefits. So again, whether it's terminal illness, epilepsies, diagnosis, or now dealing with being paralyzed from the waist down, had a stroke, a heart attack, things like that. You guys, life happens. So I want you to really take an element and take a step back and look at who in your family do you know that's had something happen to them, a car accident, and now they're affected permanently, or heart attack, stroke. I have a cousin, she just went through a triple bypass last month. So I'm actually helping her. I'm actually staying with her right now and have been here for this past month as she goes through her healing period. And then you've got people with diabetes, neuropathy. You've got folks that are dealing with cardiovascular issues. You know, I have a friend of mine, a client of mine in my real estate world. He used to be a builder, and he was also a fix and flipper. And he just did the most amazing work in Scottsdale and Tempe, and absolutely breathtaking. I mean, he would take out retaining walls in these 1970s and 80s homes and put in these steel beams in order to make sure the structural was there in place and intact, and do all of these amazing open concept living. You thought you were walking into a 2020 home. So crazy. I mean, huge walk-in showers, like thought you were walking into mom. I mean, it was beautiful work, absolutely just beautiful work. And he was on his way home to Gilbert from Tempe and was at the tail end of an existing accident on the 101 heading southbound. And if y'all live in there, you know where I'm talking about. But this was years back, and he was on the tail end of that existing traffic jam. And a young lady, not paying attention, texting, blew right into the back of his contractor van. So he woke up 30 days later from a medically induced coma because of the severity of his injuries, to finding out that he's permanently paralyzed from the waist down. So again, you tell me how many people are waking up today, and at the end of the day, something shifted in their world. And that happened to my really good friend Mike and his lovely wife Kay. So I'm just saying, life happens. I can give you another instance. One of my real estate clients, so where I was that realtor, made it happen and got it done, that's who I was. I mean, I was so passionate about doing real estate, 18 years, you all. So that was my passion, was to take all that mortgage background I had and just find a way to help my clients understand that if they did X, Y, and Z, they could own a home. And so that was my focus. And, you know, and I was able to get this wonderful family, got them, and I've done this to multiple families, but got them into this home, beautiful home up in Surprise, and, you know, close to 3,000 square feet, beautiful, beautiful house. And she just did this amazing decorating. Oh my gosh, just absolutely beautiful stuff. 2 children at home, 1 up in college. And I want you to think about this. So if you're in a home right now and you've got children, or you plan to have a family, and, you know, life is good right now, right? You think you got it all figured out. And 5 years later, you're now dealing with, you know, you got a job that's paying you just a heck of a good amount of money, say 6 figures, and you're able to afford this lifestyle that you have. She got diagnosed with epilepsy. So she would have seizures and could not do her job. She lost her job. So if you lost your job and you were not able, you got diagnosed with MS, anything, or you were dealing with cancer, like, you know, you need to focus on your health, right? You need your treatments and get better, right? You lose that income, and Social Security disability does not pay 6 figures. Is it going to pay what you're used to making, is my question. So in this situation with this family, so they lost that income, and then they were facing foreclosure. So I did my rounds that I did in the holiday season, delivered my jalapeno bread to all my real estate clients, and had an opportunity to connect with them. Things were off when I visited. They were super quiet, super reserved. I'll never forget that day. I didn't really understand what was going on. And 2 days later, they called me, asked if I can come over, and said that they just needed my help. So We got to have that conversation. That's where I found out the situation. So I was able to get that house sold literally a week before the foreclosure date. And it was a challenge because she would have a seizure. I had 21 cancellations for showings on that property. Oh my gosh, it was so stressful. But my point is that we just never know what tomorrow is going to bring. We just don't. And you just really, I'm getting emotional about it. To have to move that family out of a home where I was the realtor that made it happen and got it done for them 5 years earlier when they bought that house, to 5 years later where their daughters were, let's say they were 8 and 10, and then 5 years later, now they're freaking 13 and 15, and they were immersed in their community and their neighborhood and their friends. And to have them pulled out of that and moved into a rental property, I don't know. It really jacked me up. It just jacked me up emotionally. So she is part of the reason why I do this. Because again, being a realtor that made it happen and got it done. Now I want to be that agent that helps families keep their homes, keep their dignity, keep their assets, and not have something like that happen to them, because now they're protected with something that has living benefits. So I know that's a lot. I have more stories I could share, including the family farm. So, it's just sad, 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 sad. So, okay, let's move forward. So death benefit here, 100,000, and has the living benefit rider attached, and living benefits actually is free. Now, what I like to focus on is like how many months, especially with terminal. I think it's a joke. Sorry if I'm offending anybody, but I'm just saying, if the terminal illness rider acceleration clause in there is at 60 days, I just really upset with that. It really should be at a bare minimum 12 months, because in my opinion, you want to give yourself an opportunity that you can utilize those resources to maybe go have additional resources to go pay for treatment, or go out of the country and get treatment and do whatever you can to heal. And I've heard of stories of that happening. Better yet, even 24 months, right? But you can't get all of these kind of features in just one. Maybe you can, but with all these A-rated carriers that I've got, I've scrubbed and scrubbed. So my point being is that you want to look for, I think, in my opinion, at least 12 months. Okay. And then chronic and critical. Okay. So think of dementia, think of, a stroke, things of those nature. Okay. And yes, this has the ability to borrow against it. Now, if you do borrow against that, there's always going to be a caveat to that. So if you're doing that before that year 25 to get your guarantee of return of premium, and you didn't pay back your loans that you borrowed, well, you just negated that whole situation, because now you're affecting the growth of that policy. So you have to keep that in mind. But if you wait and you don't even need to, and you also have an impact of this age 90 situation of guaranteeing this policy, because there's a cost if you borrow a loan and you're not even paying the interest. So you kind of do the math and think about that as far as logistically. So, but if you are going to pay it back, then you should be good. All right. But we always want to read the fine print. All right. So the illustrated rate. So remember I talked about, and I know I don't have an illustration. I apologize. There's just too much going on with this piece of information here to bring in another document. So I want to just focus on, when you do get an illustration and it's on the Index Universe Life, there's going to be 3 columns on the right, 3 columns on the left, 3 columns in the center. The left is going to be what's guaranteed. Okay. On the right, it's going to be what is I don't want to say wishful thinking, but the focus of, hey, this is based on a conservative number, but it can go down and it can go up, but where is the average? And, so you want to understand your policy. That's number one. So these numbers right here that I'm going over, this down here where it says non, and that because this is non-guarantee, these are all from that right-hand column. But where I go with that is, it's okay to put your money into something if you have a good exit strategy. Okay. And that's what this is about. Return of premium of 100% at year 25. Okay. Guaranteed till the age of 90. You know, just by putting your money in there, set it and forget it type thing, and see what happens. And if it's not performing at year 25, okay, well, then you have the opportunity to make some decisions. You can say, do I want to look at the count? Do I want to take out the cash value? You put 36,000 in, but in this quote unquote illustrated rate of 5.51, it could be 6, it could be 7 as an average. I don't know. I don't know what tomorrow brings. Therein lies my reason why you want to have, I feel like, guarantees put in place to give you that protection around your protection. That's, if that makes sense. Hopefully it does. So I did this based on age 65. What would be the death benefit and or access to a percentage of your accelerated benefits for living benefits? Could be anywhere up to 80%. Okay. Cash value and or total paid. Okay. So if it's total paid was 36,000 and you're done by age 65, well, then you're going to get 100% of that back in this case. Okay. And 85. Okay. 36,000 paid because I had you done by age 65. So these are the numbers breaking it down. So look, 36,000, and I don't know, will we live to age 105 years old? You guys might in your 40s. Because again, we are living longer, but we are living sicker. Okay. So just communicating that, and that sickness comes with a price, not only with our health, but also a price tag financially. So over here is the same policy. Remember, I told you we're doing side by side, apples to apples comparisons. So the apple comparison, this is just a different apple, but it's still an apple, same policy. This is max funding it. So I'm saying if you were to max fund it, same policy, put more money into it. And there are guidelines with the IRS. So you have to make sure it's not going to turn into a taxable event. So there are boundaries that you can't exceed a top end. You have to, there is a ceiling of what you can put into a policy. Okay. And there's parameters built in to make sure that it doesn't get turned into a taxable event. So I just want to try to keep it as simple as possible to that. So in this case, I reflected 3,000. So that, that's only $250 a month. Okay. So I'm showing you taking a $100,000 policy. That's level. Remember, I said we're more focused on building cash value faster. And then let the policy with the cash value push it up in growth into the policy coverage. Okay. So that's what this is showing here. Again, this is the non-guaranteed column down here. But here's to this point. If I'm putting you into giving you an example of where you've got protection all the way around at age 90 as far as guaranteed coverage, and you're also able to compound growth much faster, because look at this. Now we're talking at 85, instead of 148,000, you're talking an extra 140. You doubled your growth rate. Granted, I don't know what tomorrow's going to bring. It's not a guarantee, but I'm showing you the power of the compound. Okay. And you're only talking $250 a month. And yes, that could be a lot for some, but, and then when you can't do it, then you don't do it. Okay. But as long as you kept on maintaining this, you secured your guarantee element of having a policy in place to age 90. Okay. You guaranteed anything you do pour into this at year 25 to get 100% of your money back. So if you put 57,000 versus 36,000, you're getting 57,000 back, because that's what you would have done by year 25. Okay. Whatever you did by year 25, you would get that back. So hopefully that makes sense. Okay. So now, same policy, just some different apple, but it's still an apple. Okay. So now we're doing the increasing. I changed this to an increasing up to age 60. I think it was, yeah, I'm pretty sure it was age 60. So now my focus, and I want to explain why I think that's really important, because as our policy can grow, look at this right here. So see, this is just Yes, $1,900. So it's like what, $300, $20 extra a month or something like that. $22 a month extra. Okay. But look at the compound effect. Okay. Looking at how this works. So yeah, you put in an extra $6,000. Sorry, it's been a long day because I've already recorded this video. Well, no, I already did this video, but it never recorded. Anyway, so we're doing this again. All right. So anyway, again, raw and real, there's not going to be any editing, so you get all of that craziness in there. Okay. So, but look at this. So the difference in this. So cash value is higher at age 65. The growth is higher, and age 85, age 105, you get to see the comparisons from this one here to this one here. Okay. Now come over here. And now we're going to look at this one. Now I'm max funding this, and we're doing it at 3,600 because now keep in mind, we're not doing 3,000 because the cost of insurance is based on age, health, and actually the policy value, like the death benefit. So if it's growing higher, then there's a little bit more cost. And then we also want to basically fund it enough that it's going to perform and be guaranteed and keep things and give you a better performance. Okay. And I'm not saying you have to fund it to this much. You could do 1,900 to 3,600. You could do, 2,500, whatever you wanted to do. This is the great thing about this. So this whole thing is just an exercise of me educating you, because you get to design, you get to build your own cruise ship. I'm just showing you the tools that are available out there with the right policy, that you can have not only the protection protecting you as you're protecting you and your family, okay, with the return of benefit and with having a policy in place to age 90. So I think those are super key. Okay. So 3,600, again, you're only talking, and then you're talking about $300 a month. And this is, you do this when you can. And granted, I'm showing this out of the gate, but because that's what I'm just trying to give you some sort of idea of what is possible. And this isn't even a higher policy. This is 100,000. I'm trying to keep this very simple, the power of what's available. And if you're in a position to do a heck of a lot more and you want to look at a $250,000 illustration, then get with a life agent that could do that for you. And I know a really good one. So, and if I'm not approved in your state, it just takes me a couple of days. I thought I'd throw that commercial in there for you. But look at this here. So let's say this is a performing product, as far as growing with the indexing strategies. Well, wouldn't that be nice to have this 848,000 in place, well into, going into your 90s or whatever that looks like as you're getting older. This is showing it at age 105. Again, living longer, but we're living sicker. And the younger you are, the potentiality of you seeing age 100 is very likely. Okay. Because they actually have mortality tables out to 120, by the way. So just saying. Okay. So hopefully all of that makes sense. I just think it's really valuable for you to see that the power of compounding. And here you're done by age 65. In this illustration, I can have this set up for like a whole life, just to put in things in perspective. Typically, you're paying that all the way until it's fully funded. If someone's paying starting in age 50, I mean, they're certainly going to be paying that probably until age 90 or 100. So just communicating that. So having these kind of numbers and trying to get this banged out by age 65 is actually awesome. So anyway, so just want to communicate that. Now let's look at, what does this look like at age 48? So because my client, he's 43 years old. Okay. 43 years old. And we are just creatures of procrastination. I mean, I procrastinate. We all procrastinate. I mean, if you don't, and you got the secret recipe of not doing that, that's awesome. And maybe it's a 5-second rule. There's a book on that. So, but anyway, I ran this, taking this one here to this one here. and keeping the dollar amounts the same. And I wanted to show you the leverage of why you want to be the advocate of your future self, because look at the dynamic. Let's just go straight down to the punchline here. 848,000 or 559,000, 235,000 at age 85 or 357,000. And it could be a lot more, again, depending on the growth aspect and how involved you are in staying on top of that as you have your indexed universal life policy, or having your agent involved with you and doing the annual review that should be going on. So, these are really important so that you understand your policy and you're maximizing and capitalizing on whatever growth that you can get out of that policy. But a big difference, right? And less is paid in, so less is going towards that, and the cost for the insurance is higher. So because this person started 5 years later instead of when they were thinking about it or considering it, and it was on top of mind or in the back of their mind, but they knew that they should get it. Well, now I want to show you the cost of what it costs you by waiting. I mean, it's really important, y'all, that you take a look at that. And that's saying that you got through those 5 years unscathed. Okay. I talked to you about my client, Mike, and I talked to you about my one other client who had the epilepsy diagnosis. There's thousands of situations every day that people wake up and at the end of the day, they have something that they're dealing with that they did not expect. And if you say that I've got policy through work, she had work benefits. She had amazing benefits. When you lose your job because you can't do your job, do you have those benefits anymore? And do they even have the living benefits attached to it? 99% of the time, the answer is going to be no. Okay. You want to own your own policy. I have a video about that on my channel, by the way, saying, yeah, you said that you have it through work. You need to watch that. It's really, you want to have your own policy. It's really important. Okay. So I told you I was going to talk to you about term, and I want to give you a kind of a reason why I feel like it's so important. Okay. So with term, first off, for those that don't know, term is a period of time that you have a policy in place. It's a very specific time. It could be a 10-year, 15-year, 20, 25, 30, 35, 40-year term. And the longer it is, the more expensive it's going to be. Okay. So and again, health is a big factor as well. So again, I go back to if you're your youngest and healthiest today, it would just make sense for you to get a term policy at the very, 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 very minimum. Okay. And again, I'm showing this one as standard rating. I'm not even talking about, remember I talked about the simplified issue scenario, the convenience factor, taking an hour out of your entire life for the next 30 years to have the lowest premium possible. I think it's worth it. Versus paying something higher that might cost you an extra $150 more a year. I mean, really, is your hour, it could be your hour's worth more than $150 an hour, but I think it's worth it to do that and get the best rate possible. I was just going to say that. So let's go over the columns on this one here. So I did a $250,000 policy. So I'm really big on layering a term policy with another product. So, and here's why. So if a life happens event happens, do you want it to impact the one policy that you have that you're hoping to have growth and also hoping to have as you age? And do you want to really use that and play your card the day that you need it and you only have one card to play because you only had one policy or you only have this one policy? Would it not make more sense to have one growing, if you can do it and you can financially afford to do that, and one super inexpensive that is going to protect you until you're well into 73? I have the numbers here, age 78, depending on it's a 30-year or a 35-year term. Again, this is for a 43-year-old. So I'm just saying, because these are going to have living benefits. Remember, I was telling you, so this one year actually has a 24-month on a term for terminal illness. How amazing is that, that you can have access to your life insurance policy and put in a request and see if you can accelerate that policy to get access to those funds that are all tax-free, by the way, at this point in time in life. So I say that with a disclaimer because I don't know what tomorrow will bring, but life insurance benefits are tax-free. Okay. So if you're going to be the recipient to your life insurance policy and having access to your policy while you're still living, when you may need it most, to get you through those years or treatments or that year, maybe it's to take a trip, maybe it's to modify your home, maybe it's to go out of the country and get treatment that you otherwise would not have been able to do. It gives you options, is all I'm saying. Okay. Pays off a mortgage. Okay. Things of that nature, like the epilepsy situation. If she would have had this policy, it wouldn't have paid everything off. And well, it might have. But so you don't get typically 100% of it. You're typically going to get like 80%, 75%, 80%, depending on the severity of the situation. But what I'm trying to communicate here, it's something you didn't know it was even available and or even existed. And so if you have a term policy, if you have any type of life insurance policy, even a whole life, living benefits are attached in today's present day policies. And I'm a really big proponent because, like I told you, I shared the stories. Why? Oops. Second. But I shared with you the reason why I feel like those are super important. So I really hope you got a lot of value. Oh, let me finish. I forgot to tell you. So this premium standard rating, $698, and if you went with the 35-year would be $872. Okay. Now I want to preface fully underwritten. And again, I don't want to overpromise. I want to under promise and over deliver. So, it's going to have to get underwritten. I'm going to push it for a preferred rating. And I don't see why he wouldn't qualify for that. And if he does, then that 30-year, oh my gosh, $530 for the year. That's nothing, you guys, to have a $250,000 coverage and assets, covering basically you created an estate for $530. Okay. To leave to your family if you were to pass away. Okay. $663 if it's a 35-year. Now, remember we talked about procrastination? Well, I ran it, what it would cost for a 40-year-old. Well, in this scenario, he loses out on having the option for a 35 because the 35-year term is no longer available. It just isn't. The older you get, your options start disappearing. I mean, I'll get people calling me at age 60 and they're looking for even a 20-year, and they can't get a 20-year term. So I'm just telling you, the best time to buy a policy is while you're young and you're healthy. So, and you're youngest and you're healthy. So even those that are not doing so well, even if you got diabetes or you got high blood pressure or cholesterol issues and things like that, there's still policies out there, and some I can do because kind of blood pressure is like a norm now, and diabetes, if it's controlled, it can be still construed as standard rating with some carriers. So there's still opportunities out there. So I'm not trying to create this bleak situation, but my point is that every day, you run the risk of having something happening. So again, hopefully you found this very valuable, but like I said, age 48, 30-year, $1,100 for the year, not 700, and certainly not 530. So it was a pleasure. I really, really, really hope that you found a lot of value in what I shared with you today. And if I didn't cover what you wanted, feel free to reach out to me. Again, my contact info is going to be in the description below. And, I'm happy to take care of you and or encourage you to get with a life insurance agent because it's just important. Again, be an advocate for your future self, for your family, and, have the protection in place. So I wish you the best and God bless. All right, you take care.